You see a stock in a beautiful, steady uptrend, and you're convinced it will go higher forever. You buy in, only to watch it peak, roll over, and crash, leaving you holding a bag of losses. What happened? The trend reversed, and you missed the warning signs. Being able to identify the dominant trend is a crucial skill, but being able to spot when that trend is exhausting itself and preparing to reverse is what separates consistent traders from the crowd. It's the difference between riding a wave all the way to the shore and getting dumped by it. In this guide, we're going to synthesize everything we've learned about candlesticks, volume, and moving averages to create a complete framework for trend identification and reversal spotting. You'll learn how to read the market's structure, recognize the specific patterns that signal a trend's end, and use momentum indicators to confirm that a change is truly underway. The absolute foundation of trend analysis is understanding market structure through swing highs and swing lows. This is the most objective way to define a trend without any indicators at all. In a healthy uptrend, the chart should make a very clear pattern of higher highs and higher lows. Each peak is higher than the last peak, and each pullback trough is higher than the last trough. This is the very definition of a bull market. As long as this pattern remains intact, the trend is up. Conversely, a downtrend is defined by a series of lower highs and lower lows. Each rally fails to make a new peak, and each decline pushes to a new low. The first and most critical sign of a potential trend reversal is the breaking of this pattern. For an uptrend, the first warning sign is when the price creates a lower high. It fails to make a new peak, indicating that buying pressure is waning. The confirmation of a reversal comes when the price then breaks below the most recent significant higher low. That previous level of support has now failed, signaling that the trend has likely shifted from up to down. This break of structure is your first and most important clue. While market structure gives us the skeleton, chart patterns put the meat on the bones, providing clear visual representations of the battle between bulls and bears at key turning points. The head and shoulders pattern is one of the most reliable reversal patterns you will ever learn. It forms at the top of an uptrend and consists of three peaks: a left shoulder, a higher head, and a right shoulder that is roughly equal in height to the left shoulder. The key level is the neckline, which connects the lows between the peaks. The pattern is confirmed when the price breaks down below this neckline, especially on high volume. This pattern represents a final, exhausted push by the bulls to make a new high, the head followed by an inability to muster the same strength on the right shoulder. The breakdown signals that the bears have officially taken control. The inverse head and shoulders pattern works the same way at the bottom of a downtrend, signaling a bullish reversal. Another powerful reversal pattern is the double top. It looks like the letter M and forms after an uptrend. The price makes a high, pulls back, and then rallies back to test the same high but fails to break above it. This failure to make a new high creates two distinct peaks. The pattern is confirmed when the price breaks below the support level that sits between the two peaks, known as the trough. This signals that buying pressure has been exhausted at that price level. To add another layer of confirmation beyond pure price action, we turn to momentum indicators. These are mathematical calculations that help us gauge the strength behind a move and can often warn us of a potential reversal before the price actually breaks key levels. The Relative Strength Index, or RSI, is a classic momentum oscillator. It moves between 0 and 100. The most common reversal signal is called bearish divergence. This occurs during an uptrend when the price makes a new higher high, but the RSI makes a lower high. This is a powerful warning that while the price is still climbing, the underlying momentum is actually weakening. The rally is losing steam and becoming vulnerable to a reversal. The opposite, bullish divergence, occurs in a downtrend and can signal a potential bottom. Another essential indicator is the MACD, which stands for Moving Average Convergence Divergence. It shows the relationship between two moving averages of a stock's price. Traders watch for the MACD line to cross below its signal line, especially when it happens while the indicator is at an overbought level, as a confirmation of selling momentum. No single signal should ever be used in isolation. The most powerful trades come when you get a confluence of signals all pointing in the same direction. For example, imagine a stock that has been in a strong uptrend but is now showing a lower high, breaking its market structure. At the same time, a head and shoulders pattern is forming, and as it breaks the neckline, the RSI is showing a clear bearish divergence. This is a symphony of evidence telling you the trend is reversing. Your job is to learn to listen to that music. The goal is not to predict the exact top or bottom, which is impossible, but to recognize with a high degree of probability that the trend has changed and then act accordingly. Managing your risk with every trade. Remember, this is educational content and not financial advice. All trading and investing involves risk, including the potential loss of principal. It is crucial to practice these concepts in a demo account and develop a solid risk management plan before trading live capital. If this framework for spotting trends and reversals has given you a clearer roadmap for your trading, please show your support by liking this video and subscribing for more actionable trading education. Now, I'm curious, what's the most challenging part of identifying a trend reversal for you? Is it the patterns, the indicators, or knowing when to pull the trigger? Let me know in the comments below.